There will be no rate cut this month. Inflation is still running hot and the jobs numbers are simply too strong. Bond yields are spiking on this news and fixed rate mortgages are about to increase. And good old Toronto's pre-sale condo market, well, it's gone from bad to worse to now catastrophic. The national real estate data is out for June, and we are showing a growing trend that might even surprise you. There is also some very unique data regarding consumer insolvencies that we're going to share. It is an ever-changing real estate landscape, and today we've uncovered what is important for you. Now, first up, we've got some interesting news. We are going to be hosting a webinar, our first one, and it is all around the small scale multi-unit housing initiative, also known as Bill 44. That is 1 year old already, and the outcome is really starting to take shape. There are, in fact, over 700 building permits that have been submitted between Vancouver and Burnaby in regards to building Multiplex. Our group is currently marketing 3 of these Multiplex projects, and we're going to be bringing 14 homes to Vancouver and Coquitlam. So a very unique program has been created thanks to this Bill 44, where prior homeowners could really only just bring their home to the open market and hope to sell for a good price. But today, and what we're going to be sharing on this webinar, is that homeowners can partner with a developer, have multiple units built on their property, and benefit from the increased sale revenue. Some homeowners are seeing pro formas where they will gross upwards of $1 million more than if they were to just sell on the MLS. Significant amount of money. So in partnership, with one of our builders on this webinar, we're going to show homeowners exactly how you can participate in this strategy. You're going to see exactly how much more money you can make by utilizing this strategy, get a clear overview of the small scale multi-unit legislation. Find out if your lot qualifies for 3, 4, 5, or even 6 units, how you can co-develop your land without needing any construction, background, architecture, even financing on some of these. So we are also going to share real world examples of some of these projects that are underway today and share basically the step-by-step guide from beginning to end of what these look like. So if you are interested in learning more about the small scale multi-unit housing initiative and what co-development with a developer partner and us looks like, well, you can register at thevancouverlife.com/multiplex. And of course, we will include that URL in the show notes below. We'd love to see you register and learn more about this fantastic opportunity for homeowners.
And if you're looking for something that's already built, the news doesn't stop here. We have the Vancouver Life Real Estate Group. Me and Dan are very excited to announce the launch of a stunning new townhome development in Richmond. Sarena introduces a rare opportunity to own one of just 7 exclusive 3-bed, 3-bath townhomes in a thoughtfully designed boutique development, offering timeless design, private outdoor spaces, of course, AC, and direct access to nature. Sarena delivers a lifestyle that blends sophistication and, of course, with serenity. All homes are strategically priced at just under $1 million, so first-time buyers can receive that full GST rebate. You can learn more at serenaliving.com.
We will include that link below as well. Lots going on in our world, and we'd want to share it all with you. So what is important this week in real estate? Well, we had 2 big announcements. One is inflation and the other was employment. So Canada's labor market, it basically defied all expectations this week, adding about 83,000 jobs, and that pushed the unemployment rate down to 6.9%. This blew past analyst expectations, who predicted a net 3,000 job loss for June, and unemployment would push up to 7.1%. What's more, we saw average hourly wages push up to up by 3.2% year over year, hitting $36.01 per hour, and total hours worked increased as well, up 1.6% year over year. So June's job report, it basically marked the first meaningful increase in employment that we've seen for all of 2025, which has ultimately been pretty stagnant. So question is this jobs report, I don't know, really better than expected? I know a lot of people, ourselves included, will question the StatsCan numbers, especially when you dig a little deeper and find out that the majority of the increase in new jobs were just part-time. Okay, bit of a Band-Aid effect, if you will. And youth employment is still a major problem. It sits at 14.2%, way higher, significantly higher than it was pre-pandemic at about 10.8%. So that is notable. Moving to inflation now, we saw inflation increase from 1.7 to 1.9% in June, with rent being the biggest single contributor to inflation over the past year. That hit 4.7%, and interest mortgage costs are declining, as they should, based on, of course, mortgage rates from a year ago, but they're still high at 5.6%. We also saw notable increases in gas, furniture, and guess what? Vehicles, right? Tariffs are already coming through within the vehicle industry, and that is pushing up inflation. So even though that 1.9 print was lower than the 2% estimates, it still rose, right? And more importantly, at least in the eyes of the central bank, the measures of core inflation, which, they ignore the most volatile components by stripping out the things that sort of move the most, it gives a clear view of the underlying price pressures. And those, well, they remained high because CPI median, it rose 0.1%, hitting 3.1% from last year, while CPI trim, it was flat, but still at 3%. Simply put, the underlying inflation, well, it remains stubbornly strong, stubbornly high. So with a better than expected jobs report and rising inflation, there is ultimately zero impetus for the Bank of Canada to cut rates, right? Why would you? So whether you choose to believe the StatsCan data or not, well, that is what the Bank of Canada is looking at, and that's what they're going to base their decision on, right? The 5-year bond reacted on this recent news. It spiked notably. We are recording this on a Tuesday this week. It's currently July the 15th. And at the time of recording, the 5-year Canada bond had jumped to 3.139%. That is very close to a 2025 high, and it's up like 60 basis points from the recent cycle low that we realized in April. There will be increasing fixed rate mortgages. You can expect them to be around the mid 4s. There will be no rate cut in July, so plan accordingly.
Dan, when I look at the StatsCan report, or at least the notes from the report, and you talked very interestingly about youth unemployment staying steady at 14.2%. I think a lot of those part-time jobs that would otherwise be captured by the youth are being captured by people who may already have full-time jobs who need more money. It's very hard to know because at the end of the day, 83,000 or the vast majority of those jobs being part-time, they're just not going to be able to pay for things like, a $600,000, $700,000, $800,000 mortgage. I don't see it as a huge shift in the marketplace. And the other thing too, with bond yields going up, I wonder too, to what extent, and inflation rising, tariffs might actually be kicking in, or at least price pressures from tariffs are starting to kick in now. So we could see inflation become even peskier. With that said, let's have a look at debt too. So last week, we discussed how the mortgage arrears rate was stable month over month after actually lowering from the month prior. Arrears are still below pre-pandemic levels, and a further sign of some economic stability here. And this was one I was sort of surprised to see, is that delinquencies in credit cards is actually on the decline as well. In fact, every reporting credit card trust over the past few months have shown improvements. People are paying off their credit cards more today than at the beginning of 2025. And lastly, consumer insolvency filings was actually down by 2% compared to last year. A further sign that Canadians could be getting their financial house in order, at least to some degree here, and consumer insolvencies peaked below pre-COVID levels and have continued to lower since.
So have we hit some kind of bottom in the cycle of financial stresses across Canada? Well, the housing data may be emulating such a fact, pointing to the fact that we may very well be at some form of a bottom of the cycle. And before you start typing in the comments, I didn't say things are increasing, but we might be humming along the bottom, which we've been echoing for a couple of weeks, almost a couple of months now. So the CREA, Canadian Real Estate Association, the national home sales data came out this week for the month of June. And here are a number of notable points to share. So sales volume, it actually increased 2.8% month over month, building on the gain that we saw in May of 3.5%. So that's 2 months of increased sales volumes. Now, these are off of very, very, very low metrics, but still an upward trend is an upward trend. The increase, interestingly enough, was most driven by a spike in Greater Toronto Area sales. While their sales also remain historically low, they have jumped about 17% since April. Sales for June were up 3.5% year over year. New listings lowered, down 2.9% month over month. And while total inventory across the country hit 206,000, that's just 1% below the long-term average. It's basically back to quote unquote normal inventory levels. Months of inventory, a good metric to kind of forecast where prices are going to go next, it's at 4.7. The long-term average is actually 5, and this demonstrates that the country is still within a balanced market. Looking at prices now, the HPI price for the average Canadian home, it dropped, it lowered 0.2% month over month and is down 3.7% on the year. The non-seasonally adjusted national average home price, though, we're looking at averages, $691,600 in June. That's down only 1.3% from this time last year. So we're really in like a flat market right now, right? Sales are increasing, but marginally. New listings are down. Inventory's right at long-term averages, and average prices are just down 1.3% year on year. It's just flat, stable, grinding, boring market. Yet, yes, sales well below average. So there's no question. You can't deny that in any form. They are slow, just like they are here in Vancouver. So it kind of, to me, feels a lot like a bottom that's been hit around, like I said, a couple months ago. There is no sign of it lifting, but there's no sign of it lowering further as far as sales volumes goes.
Let's dive a little deeper into Toronto here. There are a number of interesting data points from the most recent home sales in Toronto that we'd like to share with you. Home sales were up 8.1% in June and are up 20% from the March lows. Still the lowest since the 2000s, but showing stability to some degree. New listings dropped 4.7% month over month, and months of inventory is set at 5. This is easily the highest for the month in 15 years. Prices dropped 0.9% month over month and are down actually 22% since the peak. They're now sitting at March 2021 levels, more than a 4-year low. This is vastly different than the GVRD, which is at January 2025 prices, a 7-month low. Interestingly, too, the amount of foreclosures dropped dramatically, hitting a 2025 low. We've touched on this a few times on how at some point the Toronto condo market will become enticing to investors again. We have to wait for the numbers to work out. It's not today, but it's coming. Based on the monthly condo cash flow index, which has been improving since hitting a recent cycle bottom in January of 2024. At their worst, condo owners were running a negative $950 a month on average. Today, that's down to a negative $300 a month. And when you take the mortgage paydown into account, it's actually a net positive $300 a month. Now, don't expect people to jump at this option today. It's still not very enticing, but there will be a tipping point sometime in the next couple of years. Should prices lower? Should rates lower? Should rents improve? We'll see about the whole rates. I mean, Dan mentioned earlier about inflation, so we'll see. But real estate market looks to turn around if you can see any combination of these three taking place. They typically precipitate a recovery.
22% is notable. I mean, that is definitely correction. There's no doubt about it, right? I think anything over 20% is considered correction, and Toronto is absolutely experiencing it. And that's overall, right? I mean, let's talk about the pre-sale or the new construction market, because that continues to be the absolute epicenter of a collapse. There's no sugarcoating that at all. And it's getting worse too. So according to Urban Nation's Q2 condominium market survey, there were only 502 new condo sales recorded in the GTHA, which includes the Hamilton area, across that entire quarter. That is 10% lower than Q1, which was already catastrophic, 69% below 1 year ago, and a remarkable 91% below the 10-year average. What's more, there was a record amount of condo completions, just under 2,500 condos finished construction. That's up 102% annually and 5 times the amount delivered just 5 years ago. Meanwhile, sales by developers in completed new condo projects totaled a mere 131 units last quarter, bringing standing inventory levels to 60 months of supply. That's 5 years. So if no new condos came on the market and sales continued at the current pace, it would take until the year 2030 to absorb all that active new condo inventory. It's a long time. Only 3 projects totaling 891 units launched for pre-sales in Q2. Very brave, but you got to think. I'm guessing that train had already left the station prior to them making this decision. And, you can't stop it, right? The money's already burning, if you will. And 4 projects totaling 720 units, well, they were canceled. So obviously developers have to look at their bottom line and decide what is the lesser of two evils at this point. And I can't imagine any of these decisions are easy. I mean, when we look back to just a year ago, right, since 2024, 20 projects totaling 4,360 units have now been canceled and 9 are being converted to a rental. So that's what developers are looking to do, right? If they can't sell, sometimes you can kind of backdoor this development and turn it into rental and still be able to salvage some forms of income or sell it to REIT or whatnot. But a lot are being canceled as well, as we mentioned. So again, today, record inventory, boo-hoo. But trust me, this will turn into a shortage again within a few years. Plus, the May housing starts data from CMHC is out, and it revealed that Toronto saw a 22% year-over-year decline in housing starts. Okay, talk about this future shortage crisis in the works in real time. These numbers are definitely displaying that. The GTA is on track to see a 50% loss of construction jobs by the year 2029, while construction investment would fall more than $10 billion. And you just can really start to understand the knock-on effects that is going to have throughout the industry and ultimately to our government and their tax revenues. On the price front, well, sure, prices are dropping, right? Asking prices for developer-held condos are on the decline, with the average price falling 6% year over year and 16% from that market high 2 years ago. We're down to $1,212 per square foot for pre-sale or new completed condos in the GTA. The reset is clearly well underway. The real estate reset is underway. Developers are obviously not racing to submit any building permits in this environment, and it's going to take time for everything to get absorbed, as we mentioned, 5 years at the current pace. But as starts drop off and as projects are canceled and or converted to rentals, we will see this convert and the cycle will swing again. Ryan, last words on that.
Oof. Trying to be somewhat positive, I'll try and take a positive spin on this. I do think that there will be a recovery in time, not just from a building permits perspective, but also when you consider the price of the other assets, right? So when you look at how much a single family home costs in Toronto, how much does a half duplex cost or a row home cost, comparatively speaking, to a condo, when that gap becomes meaningful to somebody where all of a sudden it's now worth it to buy the condo, you'll start to see the recovery take shape. It just depends largely on what happens to the price points in some of these other asset classes. If they maintain, then you could expect to see condos become more interesting again as that inventory slowly gets absorbed. But I don't think we're anywhere near that yet.
Always interesting to watch this market. Is 16% nationally? Is that the bottom? Is there more? Is 22% in Toronto the bottom? Or is there going a lot more? Only time will tell. Interesting to see people getting their financial houses in order and seeing foreclosures slow down. But hey, that's only 1 month of data. We will be here, of course, next week with more. Have a wonderful weekend. Thanks for tuning in as always, and we will see you here again soon. Bye.